This is a very special show which we have planned for our viewers on energy PSUs. If you look at the last 1 year chart of BPCL, ONGC, IOC, HPCL, you would see there's a massive amount of rally which has happened. Some people managed to latch on to these names early, and others believe even now there are a lot of brokerages in the last 14-15 days, a fortnight or some, are upgrading valuation targets for Indian energy stocks. We've got somebody, so this for this discussing whether there's further value unlocking happened, what is this renewed efficiency focus of the managements in the last few years. We have got two gentlemen who have been at the helm of affairs at two of the most prestigious Indian energy PSUs. One is Mr. M.K. Surana, who's the former CMD of HPCL, and we also have Mr. R.S. Sharma, who's the former CMD of ONGC. Gentlemen, thank you so much, both of you, joining us on this very special show. Very shortly, Harshvardhan Dole, Vice President IIFL, who looks at energy, will also be joining us. But he's also joining us. Harsh, afternoon to you too. The point which we are going to discuss today is how much is the further re-rating possible for Indian energy stocks. Mr. Sharma, let me start with you. Even when you were at the head, we discussed so many times with you.
Yes.
Of course, the production volume was an issue, but now Mr. Modi also tweeting that there is a big find. The current management, the oil minister, everybody is sitting and taking notice of how ONGC, Oil India are going to all set to improve the volumes, both on gas and oil side. How much deep value, intrinsic value do you see in ONGC, in your eyes?
Well, I think I have said earlier also, this oil PSUs, upstream, downstream, midstream. I see Mr. Surana also here, who will talk about the downstream. They have immense, fundamental values because of, that not getting free marketing policies. Somehow their values are grossly underpriced. They have much more potential to grow. Fundamentals in terms of their resource base, in terms of infrastructure. Since you are talking specifically about ONGC, I can tell you that ONGC has been delivering in the past in the most of the challenging, difficult times at a low prices, high prices, giving subsidy discounts. Even today, despite that production being stagnant, the current contribution of ONGC to the energy sector is immense. I was there at just 2 days back at Mumbai, that celebrating Golden Jubilee function of the Mumbai High, and looking at the history, what this field has delivered, what is the further potential. Ministers was there. It was such a pleasant feeling to get all that positive environment about. And I can still say ONGC still has a lot of intrinsic depth in terms of the valuation to keep delivering for decades to come.
Right, fair point. We'll discuss that with Harsh in a minute, but Mr. Surana, OMCs have been transforming, taking so much pride. Very recently in one of our interaction, Mr. Singh, the oil minister, said that there was a time when we wanted to sell off BPCL at lower rates. Now it's making 20,000 crore cash profit every year. Why should we sell it off? So I want to ask you very specifically, do you see more value unlocking in the business models of oil marketing companies? They are now petrochemical, they are now transforming into renewable side, a lot of stuff happening. Do you see growth, earnings growth potential even from here on in OMCs?
Good afternoon to everybody and the established panels here. I see Mr. Sharma and Mr. Dole here. So let's see in three parts. One is the fundamental part. One thing is what is happening now. Third is the market realities which are guiding the thing. As far as fundamentals are concerned, the oil industries were always strong, whether it is upstream, midstream, downstream. But there was also a risk perception which was associated with it, especially in the OMC sector, that whether the pricing will be modulated by the government policies, whether there will be under recoveries. And so the full potential was not getting realized because it was always marred by that risk perception. The second thing was that risk perception was also because of the fundamental factor that the total product portfolio was dominated by the products which has got a susceptibility to market regulations. Now, over the period, the OMCs have integrated petrochemicals, renewables, and other models of the business, whether it will EV charging, whether it will be non-fuel business, the convenience stores, etc. And the direct sales business like lubricants and the industrial products, which are not actually getting affected by the market regulation, which is mostly related to petrol, diesel, and LPG retail sale and the consumer sales. Now, because of the increasing value of the products which are non-regulated in the petroleum downstream sector, the risk perception has changed a little bit. That's one part. The second part is last 3 or 4 years, the way the policy decisions are taken, whether it is the Israel conflict, whether it is the Ukraine conflict, whether it is the COVID scenario, or the Middle East conflict, the government has been very unequivocal in their stand as far as the crude supplies are concerned, the total supply chain is concerned. And the way these are managed, whether it is whether to buy Russian oil or not. So that is the second factor. So I'll tell you these are on the structural part of it. Now, as far as the market domination is concerned, the OMCs always had been value that all of us from the oil sector has been telling. Mr. Sharma has said, I also said it earlier, but it was not getting fully realized. Now, as the India focus has come, and almost all the sector are getting that focus, so there is more deeper diving in the fundamentals of the sector, and because of the change perception, the people are focused on this industry, and as such, as all of you know, and Mr. Dole will know better, that the good stocks are few now, which can create value, or many are already overpriced, and therefore that is what is unlocking the value. And in addition to that, industries have also spent capex. There is increase in the capacity. There is increase in the displayed yield. There are the more bottom upgradation projects which have been brought in addition to petrochemicals, etc., which is having the increased profitability, better operational efficiency, and increased volume. So I think that is what is the sum total which we are seeing in the OMC's valuation, and I see there is further value definitely to unlock. It is up the market to realize it or not.
Harsh, I'm sure you are also quizzed about this with your many of your clients. There was a time OMCs were available at 1 to 2 time PE. Now they have doubled, but still the PE is 4-5 times. Some say that it is not right to compare the HPCL of today or BPCL of today versus what it used to be 5 years back. The outlook, visibility, everything has changed. How much potential do you see for further re-rating of oil marketing companies, or even upstream for that matter? This is the only area of the overall PSU pack which appears reasonable even now.
Sure. It's indeed a privilege to speak when two of the industry veterans are on the panel. See, the way we look at the sector, one, relative to past 2 years, the macro environment has considerably improved over the next maybe 12 to 18 months. And typically when the macro is benign, oil marketing companies, which typically derive more than 50% of their total EBITDA from retailing of petrol and diesel, typically tend to give a very stable year-on-year QOQ earnings. And since the earnings are fairly stable, the return ratios are quite impressive. The valuation multiples therefore tend to re-rate a lot more than what we have seen in the past 2 to 3 years. So if you plot the PE multiples for all the three companies over the last maybe 20 years, in the good cycle, that is when the oil prices are benign, all the oil marketing companies tend to trade in double-digit PE multiples. Typically, BPCL has traded at a substantial premium, followed by HP, and IOC typically much lower than the other two. So were the cycle to repeat, that is, oil prices were to remain benign, I think the PE multiple for all the three companies can substantially increase even from here on. So in the base case, I think BPCL, which is typically traded at a substantial premium, can trade anywhere between 13 to 14 times on a 1 year forward basis. And then if the earnings are benign, I think the best is yet to come for all the three stocks. I wouldn't pick one over the other, but I think best is yet to come for the industry, which is the oil marketing companies. And that makes us quite bullish on the overall OMC pie.
Quickly, what about ONGC Oil India? Because these companies are massive cash, cash flow, strong cash flow generators. But it appears that now the focus is back to extract volume growth as well, both on oil and gas. In fact, Oil India has just management has themselves put it out on the exchanges. But what are your thoughts on ONGC?
See, there is no denying that there is deep value across the PSU pack. And one of the reasons why the upstream companies have traded at a discount to the downstream companies is because of patchy record in terms of volume growth. Were that to reverse, I think the PE multiples will converge with the global peers, which are typically trading anywhere between 8 to 10 times on a 1 year forward multiple. However, for that, there has to be a clear roadmap for a meaningful increase in respective volume growth trajectory. And we are actually sensing that, as you rightly mentioned, that these companies are taking inordinate measures to spruce up their volume growth, be it oil, be it gas. I think ONGC will actually achieve incremental 2 million ton production from KG Basin, which has never happened in the last maybe several years. And were that to continue, it is probably the cheapest, mega cap company in the entire market. I mean, it has doubled, but I think even it can double from here on, where the volume growth were to sustain for next, few years. And same holds the case for Oil India. For a massive re-rating, I think what should follow now is a sustainable growth in their respective volumes.
Right. Thank you very much, Harsha, Mr. Surana, Mr. Sharma. Thank you so much for putting everything in perspective, because this is a very high interest area of the market, not only for the retail HNI, but every day we speak with fund managers and everybody wanting. Sure. Mr. Sharma, you want to take a point? Please go ahead.
Hearing Mr. Surana, that reminded me the valuation.
Sure.
When this BPCL disinvestment was announced, I used to be chairing FICCI Hydrocarbon Committee,
Sure.
and I had said it is neither desirable nor doable. But the then minister had said, when he was questioned, that the government has no business to be in business. By implication, government would like to sell off all these entities. So as a result, the sentiments became very much low. And now we have seen in recent past, the new minister has strongly supported these PSUs, and we see that sentiments coming up, the basic fundamental valuation getting realized. So that is one of the reasons. In the past, they were depressed. Now they are doing much better.
Yes, Mr. Sharma, you're right. In fact, when we speak with the ministers, we are just back from Delhi. The line of thought which we get is that why disinvestment should be the only option. The priority should be to extract efficiencies, higher profitability, and then dividends to the government and other shareholders. But the priority, of course, times have changed now, and PSUs are shining. Thanks very much, all three of you, to talk to us this afternoon.